Hello, and welcome to CPA Ottawa's annual tax update. On behalf of our President, Lisa Allen, and our Vice President, Richard McNeil, I'd like to thank you for coming today. My name is Dean Blatchford. I'm a tax lawyer who helps individuals and businesses resolve significant tax disputes with the CRA, and I'll be your MC for the next hour and a half. I'm very excited about the program we have today. We have wonderful content, really knowledgeable and experienced speakers talking on really important issues like the underused housing tax, surplus stripping, and tax planning strategies for 2023. We also have a bonus speaker. I'm very excited about this. We have a bonus surprise speaker because here at CPA Ottawa, we like to take it to the next level. And so this is basically like the X Games of tax webinars. Our speaker is second in the lineup. You'll hear more about him shortly. I want to mention that we have record numbers today. We have approximately 285 people registered for the event. That includes 8 firms who bought the firm pass for this event. So we're very excited. We have people tuning in from across Canada. A couple housekeeping items to mention. We will be sending out a recording of this event at the end so that you can watch it then, rewatch it. We also we will not have a question and answer period at this on this event because we want you to have all the time hearing from our excellent speakers. And finally, at the end, we'll be sending out a survey to you to understand how we can do this better and to hear your feedback on this event. Finally, I'd like to acknowledge that I'm presenting from the unceded and unsurrendered Algonquin Anishinaabe territory, and that's something that I take very seriously. Now, I'm very thrilled to introduce our first speaker. She is an institution in the CPA accounting space here in Ottawa. She has been for the past 20 years. She's tremendously respected by her colleagues. And her firm, which has offices in Ottawa and Toronto, has a lot of non-resident clients. She was also a professor of accounting in China before she moved to Canada. So she's really the perfect person to school us on the underutilized housing tax. Please welcome from Helen G. CPA, Helen G. Hi, Helen. Helen, you might be on mute there.
Okay, thanks,
Hi.
Dean.
Yeah, hi, Helen. So Helen, tell me, this underused housing tax, it's very simple, right? It's not complicated at all?
It's not complicated, but it has a lot of uncertainty because it's new, and then we have a lot of to be discussed. So
okay, tell us more.
Okay, great. So thank you, everyone, and good afternoon. My name is Helen G, and as we know, on December 15th, 2021, the Government of Canada introduced the Bill C-8, which proposed the Underused Housing Tax Act. And the purpose of UHT is Canadian government intended to tackle foreign investors in Canadian housing market. But unexpectedly, the government spread a wide range of unintended influence. On June 9, 2022, the UHT received the royal assent. On January 31st, 2023, CRA released the UHT 2900 return. The first filing due date is April 30th, 2023 for the year of 2022. Subsequent filing due date is each April 30th. The UHT tax rate is 1%. Now, let's see who are not required to file UHT annual return. First, if any individual or legal entity do not own residential property or does not have any title on the property on December 31st, you are not required to file UHT return. For example, if you sold a residential property and the deal was closed before December 31st, 2022, you are not required to file UHT return. Second, if you are one of the following group of the excluded owners, you have no obligation to file UHT return. Here is the list. Next is what type of the residential property is subject to UHT. CRA listed the 6 types of the residential properties on UHT 2900 return. These type of properties are subject to UHT. But who are required to file UHT annual return? If a following group of people who hold residential property, they have to file annual return. So this is the group: non-Canadian citizen, non-permanent resident, Canadian-controlled private corporation, other corporations, trusts, and partnerships. From this list, we can see that the government tackles beyond foreign investors. Well, if you must file UHT return, it doesn't mean that you have to pay 1% UHT tax. There are some examples. Examples are based on type of owner of the property, availability of the residential property, and the location and the use of the residential property. The first exemption are based on the type of owner of the residential property. CR lists 7 types of owners who are UHT exempt. The first exempt is specified Canadian corporation. What is a specified Canadian corporation? If foreign owners own directly or indirectly less than 10% of CCPC's voting shares of share value. That's a Canadian-controlled private corporation's voting shares or share value. This corporation is a specified Canadian corporation. Then UHT is exempt. The second and the third is a specified Canadian partnership or specified Canadian trust. This means that each member in the partnership or each beneficiary in the trust either is an excluded owner or a specified Canadian corporation. They are UHT exempt. The fourth is the new owner in the calendar year. The fifth is when the owner died. The sixth is the personal representative of a deceased individual. Last UHT exemption owner is a co-owner of a property where another co-owner held at least 25% of the property at death. This exemption applies for the year of the death and the subsequent year. Exemption are based on the availability of residential property. The first is newly constructed property. If the property is under construction and is not substantially completed before April of the year, the UHT is exempt. Or if construction of the property is substantially completed between January 1st and March 31st, the property is put for sale to the public during the year, and the property was never occupied by the individual as a space of residence during the year, this property is UHT exempt. For example, ABC Inc. is a CCPC corporation. There are 3 shareholders. Shareholder A is a Canadian permanent resident, holds 51% of voting right. Shareholder B and C are non-permanent resident, holds 49% of voting rights in total. ABC Inc. owns a residential property and had major construction from 2021 and completed in April 2022. After the construction was completed, the property was rented to arm's length individuals. For this case, I think that this company is exempt from UHT tax. There are some other situations which are UHT exempt. These are related to property being inhabitable due to a seasonal inaccessible disaster or major renovations. If your property falls to all these categories, you do not have to pay 1% UHT. The UHT exemption also based on the location and the use of residential property. The first is a primary place. If the residential property is a primary place for the individual, their spouse or common law partner, or their child attending a designated learning institution, the UHT is exempt. For example, a mom, a non-resident who owns a residential property in Canada, and her son, who occupies that residence while he's attending a university in Canada under study permit, this qualifies primary UHG exempt. The second exemption based on use is focused on qualifying occupancy period. So what is a qualifying occupancy period? It's at least 1 month period of occupancy. And if the accumulation of multiple qualifying occupancy periods to more than 180 days, then UHG is exempt. And this is applied to the following individuals as well. There is one group I want to bring your attention. It's the non-arm's length individuals. If the property is rented to a non-arm's length individual, it has to be under a written agreement, and this individual has to pay at least fair rent. And the CRA defines fair rent as 5% of the taxable value of the property. So what about the vacation property? If the vacation property located in an eligible area of Canada and used by the owner or their spouse or common law partner for at least 28 days in the year, the UHG is exempt. This is the CRA website. You can check this link to determine whether your vacation property is an eligible region. So what if the owner owns multiple residential properties? CRA has a special rule for individual owners of multiple residential properties. If between you and your spouse or common law partner, you own multiple residential properties, you have to file an election with the CRA to designate only one property for the purpose of the exemption. Please be aware that each owner must file their own UHG return for each property. I would like to share this quick reference chart created by Video Tax. It's very useful. We just talk about who are required to file UHG return and what type of property ownerships are UHG exempt. But if you are not qualified for UHG exemption, how do we calculate UHG tax payable? We know UHG tax rate is 1%. CRA gives two options to determine the taxable value. The first option is the greater of two values, either the property's assessed value for property tax purpose or the most recent sale price of the property. For the property assessed value, I think we can refer to the assessment value on the property tax bill for the calendar year. Second, you can use the fair market value during any time between January of a reporting year to April of a following year. But note that this option requires election on Part 7 of the UHG 2900 return. If you fail to file UHG return on time, CRA will charge you penalty. For individuals, minimum penalty is $5,000, $10,000 minimum for corporations. In closing, if you are not excluded owner, you must file UHG return. If your ownership qualifies for exemption, you must still file a UHG return. If you file late or do not file, the penalty is very heavy. Since the UHG legislation is new, it has a lot of uncertainty in respect of all these provisions. We should all keep an eye on what is coming up. This ends my presentation. Thank you. I will pass my mic back to Dean.
Helen, thank you so much for that presentation. I'm so glad you did that for us. It's a I was kind of joking at the beginning when I said it wasn't complicated. I think it's very complicated, and I'm glad that we had you here because the more we hear about it from experts like yourself, the easier it'll be for us to advise our clients.
Thank you.
Thank you. Now, audience, before I introduce our next surprise speaker, I want to ask a favor of you. At Blatchford Tax Law, we are noticing more and more that CRA is conducting a lot of net worth audits. And we want to know how we can best serve you, accountants, and your clients on those net worth audits. So we're conducting a survey about them. This is going to be a survey for CPAs across Canada. It's a very short 5-minute survey. It's anonymous. And whether you know anything about net worths or ever have done a net worth or not, maybe you know nothing about them, your answers are still valuable to us. So all you have to do to take this survey is go to our website, which is blatchfordtaxlaw.com. Up at this top, you'll see a link that's there for us. You just click on that link. It's going to take you through a few of these very simple questions. And this survey should, like I said, take you only 5 minutes. At the end, you can put in your name, which will not be connected to your answers. And putting in your name gives you a chance to win one of 3 $100 gift certificates to the keg. So again, we'd be so grateful if you handed that out. We want to hear from you. Your opinion is very, and your experience is very important to us. All right, so next, this surprise speaker. Rarely do the words surprise and CRA go well together, but they do in this case, because at CPA Ottawa, we know that in the heart of the pandemic, you and your colleagues spent countless hours learning about the CEWS and the CERS in order to advise your clients and hold their hand through the application process during a very stressful time in all of our lives. And so we invited CRA to come join our webinar today to tell us about where they're at in the post-payment CEWS audits and what we can expect from that and what the results are so far. They gladly obliged, and they sent us the perfect person to speak to us today. He has 30 years of experience in the CRA, including many leadership positions in the audit and collections departments. He's also got a degree in Bachelor of Science degree, graduating with honors in mathematics. So he's a very sharp cookie. And his current position is the Assistant Director Audit Income Tax in CRA's GTA East Tax Services Office. So for those of you who don't speak government, that translates to very high up with CRA. Please welcome from the Canada Revenue Agency, Elvin Green.
Oh, Dean, thank you very much. You made me laugh throughout that whole introduction. So it's great to be here with you guys today, and I hope you look forward. I hope that you get something out of this presentation for sure.
We definitely do. Just answer my first question right off the bat. Should we be hiding in fear under our beds about these audits?
Never, never. Work with us. We'll help you through it. We'll take your hand. We'll guide you.
Okay, take me through it.
Awesome. Thank you. I know that time is of the essence here, so please, I'm going to be going through these slides pretty quickly. I'll be reading fast, so hopefully you all keep up. And Khalid is going to share the screen, the slides for me. So slide 1, before we get started, I just want to say that my remarks are for the information of registered attendees only and are not to be attributed to you in online newsletters or blogs or any other media reporting. Thank you. Okay, slide 3. The Government of Canada took targeted action to support Canadians and Canadian businesses, nonprofits, and charities that faced uncertainty and economic challenges because of COVID-19 pandemic. Since the beginning of the COVID-19 pandemic, the CRA has designed and rolled out in record time 9 emergency response benefits and subsidies programs. We've provided 2 additional benefit payments, which have delivered urgent needed income to support millions of individuals and businesses. For this presentation, we're going to be covering the Canada Emergency Wage Subsidy, CEWS, and the Canada Emergency Rent Subsidy, CERS. The CEWS was available for eligible employers for 21 periods, starting in March of 2020 and running until October 2021. Whereas the CERS was available for 14 periods from September 2021 until October of 2022. At October 24, 2021, the CEWS and the CERS programs were replaced with 2 new programs offering wage and rent support. They were the Tourism and Hospitality Recovery Program and the Hardest Hit Business Recovery Program. Slide 4, please. CRA was called on to quickly develop, emergency financial support programs for both individuals and businesses. Processes that would usually have taken years were delivered in weeks. The application processes for individual benefits and wage subsidies needed to be both efficient and easy to use in order to quickly deliver benefits to Canadians already suffering from job losses or business slowdowns or shutdowns. The Government of Canada determined that an attestation-based application process for both individual benefits and business subsidies was the only way to get critical support to Canadians quickly. Self-attestation was identified by the Organization for Economic Cooperation as an option where it is not possible to automate validation checks based on available information, and the objective was to make payments as quickly as possible. Canada is among other jurisdictions, such as the United States and Australia, who used attestation-based applications, an approach which delivered benefits quickly and for which the CRA received positive reviews. This approach relied on individuals and businesses to determine themselves if they were eligible to receive the benefits based on the established criteria. We recognized that this approach would require more emphasis on post-payment verification, which meant that some recipients would later be found to be ineligible and would need to repay the benefits. To achieve a balance between getting money out quickly and ensuring the integrity of the programs, the CRA developed automated and manual pre-payment validation activities and controls to help ensure the benefits and subsidies were provided to eligible applicants in a timely manner. Applicants who could not attest to meeting the eligibility criteria were not permitted to submit a claim. These criteria included confirming if the employer was an eligible employer type based on the business operating type code, had an active business number as of March 15, 2020, had an active payroll account as of March 15, 2020, had no duplicate claims for the same period, had no claims submitted after the 180-day cutoff period, and had a valid business number. In slide 5, we're going to talk about the compliance approach. Automated prepayment validation criteria were applied to 100% of CEWS applications. That's 5,091,630 applications to confirm eligibility and to identify claims of risk requiring additional review prior to payment. Automated prepayment validation criteria included the following risk indicators. Employer included on various high-risk lists maintained by the agency, such as claimants with a history of noncompliance, claimants linked to known promoters or preparers of potentially ineligible claims, claimants under audit and noncompliance, where noncompliance was suspected. Applications received above a specific dollar value, reasonableness of number of employees and remuneration compared to previous T4 summaries, and finally, changes in direct deposits or address information after March 15th, 2020, or the last claim. Manual prepayment verification was conducted on all claims where validation criteria indicated potential concerns regarding eligibility at the application stage. This manual intervention included activities such as phone calls to verify that certain elements of the claims were correct. Over $33 billion of the total CEWS claims were subject to manual prepayment verification. Where these verification criteria identify claims with potential concerns regarding eligibility, additional manual payment verification was conducted. This included validating reasonableness and accuracy of automated controls to confirm eligibility of the claimant, such as payroll accounts, business accounts, direct deposit and address information, etc. Reviewing historic filing data and open source information to determine the claimant's reduction in revenue was reasonable. And finally, reviewing historic payroll information for reasonableness and to confirm if eligible employees were paid. Where risk was not sufficiently mitigated following the manual verification, in general, the CRA would contact the claimant to verify the information submitted. Where warranted, additional documentation would be obtained to substantiate the claim. Comprehensive post-payment audits are ongoing to further examine the level of compliance of claimants who, based upon risk criteria, warrant further review. As of January 3, 2023, 4,117 post-payment audits are either in progress or have been completed. This represents $14.7 billion of the total CEWS payment benefits paid. This compliance approach was supported with additional controls, such as identifying duplicate business numbers or registered payroll accounts, and identifying duplicate or changed direct deposit information, among others. The CRA also consulted with organizations, including the Canadian Federation of Independent Businesses and the National Payroll Institute, to develop tools such as a calculator to ensure that the process would be as easy as possible while remaining comprehensive in terms of controls. As part of the government's ongoing commitment to transparency, the CRA also launched the CEWS registry on December 21, 2020. This web page allowed Canadians to identify which employers were using the wage subsidy to support jobs. CEWS registry is no longer being updated as the final claim period for the benefit ended on October 23, 2021, and the period to submit applications for CEWS ended April 21, 2022. Slide 6, Post-Payment Audit Program. Generally, for a traditional refundable tax credit program for businesses, verification and compliance work begins only after the end of the taxation year and the filing of tax returns. However, given the size of these programs, the CRA began compliance interventions, including audits, much earlier than it was done traditionally. Starting audits before the end of the taxation year was an innovative approach that provides taxpayers with early certainty of eligibility and allows for better stewardship. Identifying risk of noncompliance is not something new to CRA. In fact, our ability to identify and address noncompliance is something that we take pride in and is an efficient approach within the tax system that operates on a self-assessment principle. While identifying risk is not a new concept, doing so in the context of emergency benefits was. In alignment with the international best practices and with other existing audit programs, a risk-based approach to audit allows the CRA to focus on risk without creating undue hardship for Canadian business owners as they continue to recover from the COVID-19 pandemic. To identify risk, the CRA applies business intelligence tools and algorithms to the automated risk assessment of the CEWS claimant to assist in identifying those claims that were considered high risk and warrant a further review. Algorithms are continuously updated and created as new data becomes available to the CRA, such as more current payroll and tax information, or as the legislation was amended or extended. These algorithms take into consideration a variety of data elements, including GST, HST, payroll and income tax filing information, claim-by-claim comparisons, compliance history, and accounting methodologies, among others. This approach ensures CRA's efforts are focused on claims that are of the highest risk of being ineligible or overstated. Slide 7, please. Post-payment audit results. Given the size of the CEWS program, a more robust reporting mechanism and compliance program was implemented and developed respectfully. CEWS, using CRA's risk-based approach, as of January 3, 2023, 4,117 post-payment audits are either in progress or have been completed, representing $14.7 million of the total CEWS benefits paid. Results from these audits indicate that approximately 5.8% of claim amounts reviewed had dollar amounts denied or adjusted. Adjusted claims are claims where the claimant was eligible, but the amount claimed was incorrect. These include cases where claim amounts were adjusted due to simple calculation errors. However, denied claims are claims where the claimant was determined not to be eligible eligible for the CEWS, and also cases where claimants failed to provide supporting documentation to the CRA. CERS. Compliance activities are also underway for the Canada Emergency Rent Subsidy. The CRA launched a pilot in August of 2021 to verify the accuracy of these claims, gain insight into the vulnerabilities, and identify potential risks of noncompliance. The pilot has been completed, and the results are being examined. In March of 2022, the CRA started work auditing claimants identified from areas across the CRA as required further review for potential noncompliance. The majority of the referrals received to date arose from other compliance activities where potential or confirmed noncompliance was identified. Slide 8, we'll talk about post-payment audit findings. Overall, compliance audits have largely found that most claimants have applied the rules correctly and have made every effort to comply. Some claimants, however, while eligible, simply did not understand all the rules and made honest mistakes while filing their applications. The most common adjustments relate to payroll issues and calculation errors, as well as instances where the claimants failed to provide responses or information to the auditors. Where intentional noncompliance was identified, the CRA is pursuing these cases to the fullest extent. At this point, the CRA also has identified a pocket of claimants that are suspected to have committed fraud and or aggressive noncompliance, including preparers of ineligible claims who promoted and assisted in breaking or bending the rules and knowingly facilitated the production of inaccurate or fraudulent claims. The CRA is continuing to identify and pursue all preparers that appear to have prepared or counseled others to file ineligible CEWS and CERS claims, as well as their associated claimants. As of January 3, 2023, over 3,800 CEWS, CERS, high-risk preparer-linked claimants have been identified and are being evaluated for potential denial or adjustment based on ineligibility. Slide 9, CEWS post-payment audit plans. The post-payment compliance program is still underway, with plans to continue to select audits through the risk-based approach I spoke about earlier. While post-payment compliance efforts will be ongoing, it is important to note that the CRA takes malicious intent and fraud very seriously and has tools at their disposal to pursue gross negligence penalties and criminal prosecution where warranted. Where intentional noncompliance has been identified, the CRA is pursuing these cases to their fullest extent. The CRA may assess or reassess or issue a redetermination to a person for a tax year at any time beyond the normal reassessment redetermination period if that person has made any misrepresentation that is attributable to neglect, carelessness, or willful default, or committed fraud in any instances where the person has voluntarily filed a waiver with CRA before the end of the normal reassessment period, agreeing to leave the period open. Therefore, there is no deadline for reassessing in cases of fraud or neglect, carelessness, or willful misrepresentation. This is further supported through the attestation-based approach, where claimants had to attest to the information provided within the application, including that they met the prescribed eligibility criteria to qualify for the benefit. The CRA is committed to transparency with respect to its post-payment efforts and engaging important shareholders and like the CPA. This concludes my presentation today. I'm hopeful that it was helpful to you and provided a good representation of the post-payment audit programs. Thank you. Dean, back over to you.
Alvin, thank you so much. We really appreciate you being here. I know CRA's had to do a lot of work both in getting this money out the door in the first place and now to making sure that it only landed in the right hands. I know that our members will want to know one thing in particular. How laborious are these audits? How hard is it for clients and accountants to respond?
they're no different than other audits and reviews that the CRA does. Just provide the information that we're requesting, and it should go as easy as those.
Okay. So if there were, say, showed up on LinkedIn a few years ago, a long 7-page letter that had all these questions, my understanding from you is that's not the norm, and that's not how the audits are going anymore.
That's right. That might have been early days. Right now, our audits are moving forward, and we're getting very good representation and results from that.
Yeah, clearly, if you're getting 94% success rate, then it's not something we have to, like I said, go under the bed for.
Yeah.
Thanks so much, Elvin. Really appreciate it. Bye for now. We'll see you soon.
Bye-bye.
Okay, our next speaker is a tax expert who specializes in helping firms like yours handle very sophisticated tax reorganizations and transactions, whether domestically or internationally. He's a CPA, but he also has his master's in tax, and his master's thesis on butterfly reorganizations actually won a couple of awards and was published in the Canadian Tax Journal. He's taught for the Canadian Institute of CPAs, the Canadian Tax Foundation, STEP as well. He's someone we're very happy to have here. He's talking on a sophisticated topic of surplus stripping, but he's designed his presentation so it's going to be valuable from everyone from the generalists right on up. Please welcome from Kakar CPA, Manu Kakar.
Oh, hey. Hey, Dean, how are you? I was wondering if you're introducing me or someone else.
Manu, I hear that people sometimes call you Dr. Tax. Is that true?
Yeah, they call me Dr. Tax. It's a pun on in Quebec, we have a program called Dr. Tax that does tax programs. It's a pun on two things. I have a master's in tax, plus I'm married to a doctor, hence the word Dr. Tax. Plus I write a little bit. So there you go.
Beautiful. Well, prescribe to us a solution for surplus stripping, please.
Okay, I'll try. And I love to say the timing is impeccable. You're putting me on creative tax planning right after CRA's announcement after a CRA. So I'm wondering how that's going to go. No, I'm just kidding. Alvin's a great guy. I spoke to him before. So when we talk about creative tax planning, what we're going to be talking about is surplus stripping, as well as the government's view on how to curb surplus stripping, but at the same time allow for intergenerational transfers. And we're talking again about the Bill C-208 final legislation, but there are pending amendments that we're still waiting for 84.1. So what we're doing is I'm going to go into a little bit of background of what is a surplus stripping, and then potential changes. Bill C-208 changes to Section 84.1, which is again trying to curb surplus stripping. We'll see how effective it is or not, and to try to maintain policy objectives of genuine intergenerational transfer. So that's kind of where I try to marry the gap and try to make this applicable to as many people as possible, given the short time I have to speak. But I do want to thank CPA Ontario as well as CPA Ottawa for allowing me to speak today. So really what we're looking at is, if we look at really simple, like the 4 major provinces of Canada, we see an alarming trend, or a planning trend. And this is kind of what we look at with planning, is that, people say, what are you? I'm an accountant. But I said, yes, I'm an accountant. But I'd like to say I'm a disguised lawyer, because tax is an amalgam. It's a financial statute, right? If I look at this book, which I always have with me, the green book, right? I call this my holy Bible. In my language, we call this the Bhagavad Gita. My wife calls this the other woman, right? That basically in the book, it's a financial statute. And what happens is that basically when we look at this, we look at the capital gains rates on the personal level. These are personal rates, are higher than dividend rates, and they're quite high. There's between ineligible and dividend rates and capital gains, there's roughly about, easily in Alberta, it's an 18% spread, but they're typically around 18 to 22%. So obviously we're looking at this and saying, well, and obviously with integration, if we looked at corporate rates for the same provinces, at the corporate level is roughly 25%. And then, give or take a little bit, Ontario, BC, where the two provinces I work in a lot, because my firm is based in both provinces, is 25. And BC and Alberta are not too far off. And on a fully integrated basis, you're going to come close to these numbers on for capital gains. That you're obviously trying to favor capital gains remunerations, right? That's what it is. There's obviously, based on Duke of Westminster, that's what the Duke has said, is that we are allowed to legally arrange our affairs in whatever way we want, but it's legal to minimize taxes. So obviously we're trying to get capital gains remuneration. So that's the first thing. Capital gains are taxed lower than that lower rate. than corporate dividends in the hands of individuals. Here we're talking about obviously dividends from Canadian corporation, taxable Canadian corporations that are subject to dividend tax credits. And so here, that's what the name surplus stripping is. We're trying to extract money out of a corporation using capital gains rates. That's really what it is, as opposed to dividends. We are having to worry about 84.1, which is sort of what we're going to talk about the segs into what C208 was trying to address, to curb surplus stripping, as well as allow intergenerational transfers. And what happens is basically they're saying what 84.1 says, that, well, it prevents non-arm's length surplus stripping by the use of using the tax-free ACB for VDA value or lifetime capital gains exemption for the individual or related person. And so what happened was the CRA with court cases have tried to restrict surplus stripping beyond Section 84.1, but based on cases like Gwartz, generally the case law sides that there is no overall scheme in the Act against surplus stripping, right? And now obviously they tried to introduce proposed 246.1 into July 2017. But proposals, which a bunch of us call the Morneau Massacre, but that luckily never went through, which was proposed 246.1. Right, so that sort of reaffirms if the finance was trying to reintroduce legislation to try to curb surplus stripping, it meant to say that they generally failed. CRA and Department of Justice failed in the courts as a general rule to counteract surplus stripping via court cases. Now, here's an interesting thing with surplus stripping, where we're using 55.2, which is one of my favorite sections of the Acts, where we're trying to intentionally, and this is before 55.5F was amended, where before what you used to do was basically saying that you would have to designate a dividend between safe income and dividend and a capital gain that's not attributable, a dividend that's going to be converted into a capital gain that's not attributable to safe income subject to 55.2. That used to be on a designated basis. Now it's automatic. And what happened is that there used to be planning in place. And basically they used to say that, well, we would not intentionally not file the 55.5F designation to generate a capital dividend account to surplus strip. Right now it's automatic, right? So it's automatically done that you must bifurcate between, if you have a safe income dividend and a dividend subject to 55.2, it's 55F automatically applies since 2016. But the CRA response was that basically all of the GAR committee considered the transaction circumvented the integration principle. It is recommended that the GAR be applied. Right. So what they're trying to say is that, well, by basically intentionally trying to trigger 55.2, GAR may be applicable. Again, it's a bit of a stretch, right? Is that they've tried to say that, but again, with the courts, they've not been successful, right? So CRA said they may invoke GAR, but no disrespect to Elvin, sometimes CRA says they may invoke GAR for a lot of things. Whether they're successful or not is in the courts, and obviously the success of the GAR is obviously a bit muted, because you can see there's consultation papers out right now on the GAR to try to beef it up with more of an economic substance over form doctrine, but that's a discussion for another day. So what are the changes to curb surplus stripping? Well, one is that you could reinstate the July 18, 2017 proposals and say, well, what we're going to do is say that we're just going to try to reintroduce 246.1 to introduce legislation to stop surplus stripping. Or the simpler way is to just increase capital gains inclusion rates. Would you go from 50 to 2/3 inclusion? Would you go from 50 to 75% inclusion rates? Because if you do that, that's a simple way to stop surplus stripping. Because if you go back to the previous slide, the 20% gap at personal tax level between capital gains, personal capital gains, and ineligible dividends would be reduced significantly, right, to maybe less than 10%, which would curb the appetite for surplus stripping. So that's kind of a nutshell what I wanted to talk about. And there are still obviously opportunities. And, now we, just mentioning it now, the upcoming federal budget, we don't know when it is. It's usually end of February, March, or April. And so don't be surprised in your firms if you see, like, we get a bunch of calls usually this time of year saying, oh, we want to potentially surplus strip. There's XYZ. There's a million ways to do it. We can't go into all the varieties of how to do it because of lack of time. What do you need to do? And that's you may be getting calls from your clients on this because, especially if clients on the cocktail circuit, unfortunately, the word surplus stripping, I guess maybe because of the sexy title or not, is actually a popular word that people actually see saying. I get calls from people saying, I heard my son, I don't know what it is, but my friend is surplus stripping. I don't know what it is. As long as it's not illegal, I want to try it. So that's sort of the conversations that, you get into. So now we have about 9 minutes left, and time flies when you're having fun talking about tax. We're going to look at kind of the proposed changes to Section 84.1. And interestingly, what happened was Bill C-208, again, this is some history here. It was generally opposed by the Liberal Party and Department of Finance. It became law in very unusual circumstances with a backbencher bill. And what happened was, because the law was drafted in a hurry, there was sloppy drafting that may not achieve the desired intent. And what they're trying to do is they're trying to table amendments to the final legislation, but it hasn't happened yet. And this is kind of what this second slide says as well. On June 29, 2021, we received royal assent with very shaky law, and we're still waiting for amendments since then. So now what happens to new paragraph 84.12e? What happens is that the requirements are that, well, 84.1 will not apply, and that the taxpayer and the purchaser corporation, which would normally not be dealing at arm's length, are to be dealing at arm's length, and to avoid a deemed dividend characterization for the individual transferring the, let's say, shares to a Canadian corporation. And what 84.1 would do is eventually would recharacterize the personal capital gain, potentially subject to a capital gains exemption, or even just lower rates of tax into a personal dividend. And what happens is that if 84.1 does not apply and the purchaser and taxpayer dealing at arm's length, then you get a capital gain. What are the requirements? Well, the purchaser corporation is controlled by one or more children or grandchildren of the taxpayer who are 18 years or older. Subject shares must be QSBC or family farm or fishing corporation shares. Purchaser corporation must dispose of the subject shares within 60 months of their purchase. That's an asterisk there. Reduction for $10 million taxable capital, presumably the target, and you need to have an affidavit and valuation that's sent to the CRA attesting this. This is a big one. The purchaser corporation does not dispose of the subject shares within 60 months of the purchase. What does that mean? Well, it means that if you have share exchange under Section 86 and 85, that can invalidate it. Amalgamations. So typically when you have a leveraged buyout, we're dealing with several right now. You have a purchaser corp acquiring shares of a target. You amalgamate to push down the debt into the target. You can't do that because you got a disposition of the target company shares by purchaser corp. It is unclear if the indirect sale is allowed, either sale the shares of the purchaser corp instead. So if you sell purchaser corp instead of target, are you out of this or not? We're not sure. And the 60-month hold is that, well, we have a 3-year normal reassessment period, limits the CRA ability unless they think it's gross neglect or fraud, right? Under, I believe, 152.4 and 4.1 that says, well, you normally have a 3-year reassessment period for individuals that kind of limits the 60-month hold period. This is kind of we're trying to say the uncertainty in these rules, which is kind of why we try to stay away from planning with these rules. We ironically have a file right now that clients insisted on it. And even then we're telling the client they're indemnifying us in case the law changes retroactively, right? Because we've told them we're dealing with very, very, very shaky rules right now. New paragraph 84.12.3a, it sort of modifies the charging provision of 84.12e, right? And it sets up certain constants that arise. The purchaser corporation disposes of the subject shares within 60 months of the purchase. The 60-month rule has a carve-out exception if shares are disposed by reason of death. We don't know whose death. We assume it will technically be the parent, the grandparent, child, or grandchild. We assume it means the parent or grandchild if there's a carve-out exception for deemed disposition. We don't exactly know. If the 60-month rule is broken, well, then 84.12e never applied in the first place. So what ends up happening is, well, the taxpayer is deemed to dispose of the subject shares to the person who acquired them from the purchaser corp. So if the purchaser corp sells the shares on to somebody else and that person is arm's length, there's no problem. But what it does is it basically puts it gets rid of the intermediate purchaser corp and says, well, who was the ultimate buyer? We go back to the individual who sold and are the two at arm's length. So there may not even be any problems with these rules, right? So that's kind of what that issue is. Controller ownership. Well, there's no requirement for the children or grandchildren to be involved in the business. They must control a purchaser co. You can have. It doesn't appear that that children or grandchildren must control target co. They just say must control purchaser co. Vendors appear to still have. You can have a non-controlling interest in the purchaser corp. So what could happen is the kids can just have thin voting shares in the purchaser corp. The parent, who's the vendor or the grandparent, can have all the non-voting participating shares. So nothing's really happened, right? So we have to look at against Dean's Knight case, what's relevant for actual control. We don't know, but we're just explaining that that there's a lot of ways around this, right? Like in Quebec, where I'm from, these rules are very strict, where it says the vendor must leave the business completely, and the kids have to be taking control of the business, and the vendor can have no shares, or if they have shares as vendor take back, they have to be sold or bought back within a certain amount of time. There's none of that here, so there could be a lot of abuse potentially using these rules, which you suspect will be adjusted in the upcoming amendments, which we've been waiting for now over a year and a half, right? So that's kind of important as well. Here's some questions here, again, from KLU CRA Finance Roundtable. Well, they said 84.12.3b of the Act appears to provide for a reduction in the capital gains deduction in calculating subsection 110.62 or 2.1. So what they're trying to say is if you're a large taxable capital, the target is goes between 10 to 15 million. 84.123A is supposed to say, well, we're going to reduce the amount of the capital gains exemption you can claim. But the problem is that if you look at it technically, 84.12.3A or in 2.3B only applies for section 84.1 of the Act. It doesn't apply to the charging provision that affects the quantum of the capital gains exemption under 110.6, or 2.1. So we think the tax community thought that this isn't, even if you have a taxable capital over 15 million, the target, 84.123A and 2.3A and B cannot even apply to reduce the capital gains exemption because it's the wrong charging provision. And CRA basically said, yeah, we agree. Even if the taxable capital is over 15 million, there's no impact to the law, right? There's no impact to reduce the capital gains exemption available. And so there is no impact. So really you could have so what I think the purpose was is that they didn't want you to claim the capital gains exemption on these intergenerational transfers on large businesses that are generally, that were in the old rules, subject to the SBD grind prior to them, again, changing it in the last budget that they moved it to 50 million or 2 budgets ago. Now they said from over 10, if it's over 15 million, their intention was to grind the capital gains exemption, which is not even applicable because it does 84.123.2.3b does not affect 110.6, does not affect the charging provision affecting the capital gains exemption. Hence, we can see it's sloppy law, right? That's all we're saying. Well, the other question here is that what happens what are the implications if the affidavit is not provided correctly? Well, guess what? There's nothing. You're supposed to provide it, but they don't say in the law what happens if there is no affidavit provided. So again, it's a bit of a technical glitch, I guess, that they have to fix, right? Here's an example that CRA provided for an affidavit for an individual requesting evaluation. Note, you need to typically have a commissioner of oath or notary public sign off that they've, I guess, seen this value, it's been presented to them and all that. What are potential changes? We're wrapping up soon. Well, what they need to do is they need to address what are transfers of legal and factual control, right? Typically, you want the parent to transfer both from a policy perspective, to permit intergenerational transfers. Level of ownership the vendor can maintain after transfer. Requirements and timeline for transition. The level of involvement of the purchaser after the transfer. So in budget 22, which again didn't happen, is that there's still consultations. So in budget, there's still consultations away with the stakeholders, which is why it hasn't come out yet. Hopefully in 23 budget it will. We might, the way it's drafted right now is that C208 could prevent surplus stripping without as we indicated with control, without genuine intergenerational business transfers, which is not the intent of the legislation, but opportunities. Again, these are some KLU comments that they have potential changes. And basically the risk is, though, if you put too much legislation in, right, and you make it too restrictive, it could become too prescriptive and restrictive, which will what will happen in Quebec with their intergenerational transfer rules, which I can tell you in practice no one uses because the 8 main conditions and then the 14 sub conditions of the 8 main conditions are too restrictive and no one ever uses it. So that's what they're trying to balance, is that they need to put more legislation in, but they're trying to avoid too much legislation in order to avoid the Quebec syndrome, which is what happened, that no one's using these intergenerational transfer rules. And on that note, I am 1 or 2 minutes, I'm actually a little ahead and on this right now. And I finished my presentation. But what I just like, I can still talk. I have no problem with talking. You can tell I love tax. Is that really surplus stripping for now, given the low rates, is a great opportunity for owner managers to remunerate themselves using capital gains, implemented properly based on the case law. I'm not saying it's a slam dunk. I'm not saying Elvin's listening. I'm just kidding. But like CRA may not attack it. They will. Obviously, if you're trying to legitimately, according to the law, reduce taxes, CRA may have an issue with that. That's their job. That's what they have to do. They have to check things. They're doing their job. And it does present an opportunity, provided that the rates are low and that as we said, that the legislation has not been yet enacted for anti-surplus stripping rules or anti-avoidance rules regarding surplus stripping. So it does provide opportunities, particularly with corporations with significant amount of retained earnings in them. And it is something you may want to look at for your clients if you haven't looked at already, which I assume a lot of you already have. And that ends my presentation. And I think I was okay for time. Dean?
Yeah, you're doing great for time. In fact, I'm going to ask you a couple questions.
Oh, wow. I'm scared.
No, I'm just thinking, like, if I'm an accountant and my firm is, hearing from clients who want to think about this, but I don't, as an accountant, maybe I'm a generalist. I don't feel like I have the skill to do this or the expertise to do this.
Yeah.
How does the process work to reach out to you? And are you able to do you ever give the clients like some sort of like probability of success, some sort of risk threshold? Is that part of your
Yeah, I
analysis?
mean, we do that. I mean, if they want to reach me, my slides were my contact number was in my slides. You can look
Sure.
me up on the internet. I'm not hard to find. CRA knows that. I'm just kidding, but I mean, so the thing is that and by the way, I'm joking. We do work a lot with CRA to work for productive tax system. So let's say you can contact me or any other tax advisor. There are different ways of surplus stripping or capital gains remuneration, however you want to look at it. There are different risk profiles, and yes, we do give an assessment of risk profiles depending on the case. And typically, like the way I do it is if I talk to an accountant who refers me, because a lot of my work comes from accountants or other lawyers like yourself or whatever, depending on the fact pattern, within like 10 to 15 minutes, we can assess whether this is a probability of a go, and we can kind of assess what the risk factor is. But I can't give a general risk factor without knowing the facts. It's like with Jamie, right, who's coming up. He can't give you a risk factor, or CIBC can't give you risk factors on investments or whatever your thing is unless they look at your particular facts. It's the same thing with this. But yes, we do that. And there are different risk profiles depending on the different types of surplus stripping you want to do.
Okay, that's great. Anything else? Any last tidbit of advice that you would give to accountants who are thinking about kind of reaching out to you or venturing into this?
Yeah, I would say, and this is not a plug for me. Like they can go wherever they want to go to. There's other competent tax practitioners out there in the Ottawa region or wherever they are, right? It's that if you don't do this regularly, like I do review files of other accountants. Like I'm fine with not doing the work, and like I want to review other files of like other accountants. But I often then say that if I can tell right away if an accountant has not really done planning before because their facts section of the memo is weak. I don't know where the facts are. I don't know where their analysis is. I don't understand what the purpose of a step is, right? And so I critique them and I keep telling them that. So to be frank, as I look at it, everyone's busy. I'm assuming that if there's an accountant who lacks work, I can hire them in 2 seconds. I'm just kidding, but I don't think there is. I think it's a question of knowing what you do and staying in your lane, as my wife often tells me, like stay in your lane. Like if you're good at doing year ends, do year ends. I don't do year ends. I'm a CPA. I haven't done year ends over 20 years. Someone asked me to do a notice to read, or I refer them off to some other accountant I work with, right? That's the same from anyone else. Is that if it's not something like everyone can understand the concept, right? But if you don't do it regularly, there's too many details that you can get messed up on that could get your client in trouble. And let's put it this way, more importantly, or equally importantly, get yourself sued, right? And as we know, tax in the accounting and legal profession is the most litigated, both in volume of cases and quantum of cases of litigation. And that's something we're very careful of. And I would advise the accountants as well, is to be very careful in treading on this, because it's not something you just go look online and say, let me get a template of an instruction letter. Let me get some extra money for my client. It's not worth it. And I'm not trying to do this as a plug for me. They can go wherever else they want. You know that.
Yeah, no, I hear you. I mean, we sometimes say the same thing about tax disputes. So
Yeah, that's actually, I would refer to someone like you. I'm not going to get into like, how do you file how do you do an informal procedure or go to court, even though I can represent someone in court. I would never do it. I'd give it to someone like you. Absolutely. Absolutely. It's not worth
I
it.
don't want all your informals, but we'll see. Hey, listen, Manu, thank you so much for coming. I really appreciate it. This is a great presentation. I look forward to talking to you later too.
Likewise. Thank you very much. And thanks for having me on CPA Ontario, as well as you, Dean, and CPA Ontario. Thank you.
Great. Thanks. Okay, our next speaker, and we're like right on time here. Our next speaker is back by popular demand. We're really happy to have him here. He is the head of, let me get his title right here, my apologies. He is the managing director of tax and estate planning with CIBC in Toronto. He also writes a column for the National Post called The Tax Expert that you've probably seen in your feed on multiple occasions. He has won the award. He's been granted the award by CPA of the Award of Distinction for having made an early impact on the profession. And he's often making guest appearances on BNN and CTV and the National. So we're very happy to have him back. Please welcome, for his second year in a row, Jamie Golenbeck.
Thanks very much, Dean. And we're going to jump right into it. So we've got a jam-packed presentation for you. And,
okay, first, can you tell me about your recent career distinction that just happened?
Oh, well, that's funny. So I was recently, as I guess apparently everyone on LinkedIn seems to know, because I think it got like 40,000 likes, which is more than I've ever gotten, more than my Kawhi Leonard tax story, was that I was actually quoted recently in the case that I wrote about the last weekend in the paper about medical expenses, where a person was claiming their mother-in-law's nursing home expenses as a medical expense. And as a dependent, of course, the problem is they never actually paid the expenses. So the judge went out and did some research as to are there any other sections of the act or references to situations where you had to pay or didn't pay medical expenses, you got the credit. And we were cited, myself and a couple of colleagues from work were cited in an article we wrote for the Canadian Tax Journal many years ago on tuition as a medical expense. And we were only in a footnote. We were in a footnote, but now I can say I was cited once in my career by the Tax Court of Canada.
That's great. Well, better to have your name small at the bottom than large at the top on a tax court judgment. So
exactly. Well, that's for sure. And in fact, I almost did go to court, and I'm going to talk about that in just a moment.
Okay, congratulations. Take it away.
Okay, great. Now, do I need to share my own slides, or will they just automatically appear? They've just appeared. Fantastic. All right. So I'm going to take you in the next 25 minutes on a whirlwind tour of tax. What's going on? Number one, I'm still working from home. That's why I have this very suspicious background that I always get lots of comments on, and people say they hate it. It makes them stressed out, but not for this group. Makes us excited, right? So still working from home. We'll talk about that, talk about my personal story. I almost went to tax court, give you an update where we are in terms of 2023 rates, talk about registered plans, some other personal tax stuff, give you an update on corporate tax, where we are for small business tax rates, and finally, housing is the big topic of the year. We'll spend a few minutes on that at the very end. So I am actually still working from home. This is another year in which you can claim COVID benefits. I actually had to get a T2200 for my own working from home last year. I thought it was automatic. CIBC used to give everyone one, but now you had to actually certify that you really were working from home. My boss had to sign off. So anyway, I am still working from home, and I actually got audited on that in 2021. So reminder, there are two ways to do it, right? $2 a day or $500. The detailed method is the actual expenses. Based on my personal situation, I use the actual method. And in 2020, I claimed office expenses. In August 2021 at 1:19 in the morning, I received new mail from the CRA. That is never good news. And anyway, I got audited on my home office expenses. They wanted a copy of my T2200 to make sure it was signed. They wanted a detailed breakdown of all the amounts that I claimed. Credit card statements, bank statements weren't good enough. They wanted all the details of all the receipts, and they wanted the 777, and they wanted even a copy of my floor plan, which I did not have. Anyway, I sent in August all the submission. I wasn't claiming 6.5% of my home based on square footage. I sent them a detailed schedule with all the dates and the amounts of monthly hydro, gas, internet, everything, without a floor plan, and that the CRA said no good. February 22, no good, reassessment. So all my expenses were denied. And they said, send in more information. So they wanted copies of canceled checks and the stuff that I actually proved, and all the statements from all my utility providers. So I downloaded 89 pages of backup documentation to the CRA, and I paid the tax, right? Because I want to stop the daily compounding of non-deductible arrears interest, which we'll come back to in a second. So 8% is the rate right now. And then I filed the notice of objection, and I went online after a few weeks, and it was determined that my objection was of medium complexity. And that means it would take 283 days to resolve. I wasn't going to wait 283 days. So I waited 90 days. And by right of appeal, I went right to the Tax Court of Canada. And I made an appeal. I did this all myself, 1-page appeal. And I said, look, these expenses are valid. You got to allow them. Within 3 weeks, got a phone call from the CRA saying, yep, we're going to allow everything other than $99. They sent me a reassessment. And at last, I did not have my day in court. Now, you'd think this would be the end of the story. But again, October got audited again, and now I'm sending in my expenses for 2021. So maybe next year, if you invite me back, I'll update you on what happened on my most recent audit, where I sent in 120 pages of backup information. So enough about me. Let's talk about you. Personal taxes 2023. What is your tax rate for this year? Of course, it depends. Good thing is we had a very healthy increase in the brackets. So bracket creep is no longer an issue on the federal side. We have a top rate in Ontario federally at 235. And then, of course, when you add the Ontario credits, you get a bit of a mess, right? Because you have 2 levels of Ontario surtax and 5 levels of credits in Ontario. Anyway, you get basically 11 brackets. And that's where that magic top rate of 53.53 comes in. And clients are starting to know that that is the rate. Like we had a client meeting this morning with their high net worth client, $100 million. And right away he said, yeah, 53.53. Yeah, I don't want to pay that kind of tax. So people are, people know about that rate for sure. In terms of the different types of rates on investment income, obviously, whether it's taxable income, dividend income, you know, eligible, non-eligible capital gains, ordinary income. Obviously, what you're trying to do is trying to move on the investment side to less taxable income. So eligible dividends, non-eligible dividends are tax preferred. Capital gains are currently half taxable. More about that in just a moment. And then, of course, for someone with no other source of income, the last line shows you the magic tax-free amount we often do that when planning with children and things like that. They can get $55,000 of dividends because of the dividend tax credit, the basic personal amount, and pay no federal tax in Ontario or Ontario tax either. So marginal effective tax rates, unfortunately, are much higher. So there's a good report that came out in the last 12 months from the C.D. Howe Institute that really looked at the M-meters, the marginal effective tax rates, which not only looks at the statutory rates that I just showed you, 53.53, but also looks at the potential loss of income-tested government benefits, deductions, and credits. And they actually have an interesting result. So let's say you got a single parent with 2 kids, because the Canada Child Benefit is clawed back heavily on an after-tax, tax-free basis, you're getting an effective rate of almost 96%, which is kind of crazy, right? And it just shows you that our tax system is far from straightforward. That being said, if you sort of break down and you take a look at the share of income by income level, as well as you look at the various brackets in Canada, and you sort of break it down, you can really see here that the top 10% of taxpayers who make over $100,000, that's the red bars, earn 37% of all the income and paid 57% of all the taxes in Canada. If you look at the top 1%, right, the people making over $250,000 paid 25% of all the income taxes, all the personal tax paid in Canada. This is all publicly available. We put it into a fancy chart, but basically it's the CRA's final income statistics. Most recent year is the 2019 tax year. So, I mean, the wealthy are paying a lot of tax already. 10% do pay the majority of taxes. That was a Fraser Institute report from a few years ago. And yet the government is concerned that the wealthy are not paying enough. And that's why we're expecting in the new budget later this month or in April, the reintroduction of the AMT. And I'll come back to that. But this is a chart from the federal budget last year, chart 9.1, that showed of the top 0.5%, so the income cutoff federally is $400,000. In 2019, 28% of them didn't pay anything more than 15% federal tax. And you sort of remember that chart from the budget, and you say, well, how is it possible that these people didn't pay a lot of tax? Remember, this is just federal tax. And when you actually go through it, I mean, we're all familiar with the Duke of Westminster principle that really says taxpayers are entitled to arrange their affairs to minimize the amount of tax. So, if you actually break down those income statistics, you can see that, are people doing anything nefarious? Are they doing surplus strips? Maybe some of them are, but really, if you pick people at the top 1% making over 250,000, the truth is that they're not doing anything wrong. Like they're doing, dividend tax credit. 2/3 of them report taxable dividends from Canadian corporations on their return. Nothing, inappropriate about claiming the dividend credit, which tries to eliminate double taxation of corporate income. Taxable capital gains, that's the law. 50% are taxable. Claiming an RSP deduction is hardly abusive. Making donations to charity, hardly abusive. Very few people claiming stock option or capital gains lifetime exemption. So, the fact that the rate is 15% doesn't bother me, because this is the basically design of the tax system. Yet, as we know, the government is introducing a new AMT. We already have an AMT. Came out in 1986 at a 15% rate, but the budget did promise one was supposed to be in the economic statement, but they said that the detailed plan will be coming in this month's budget. So stay tuned. We'll have more to say about that probably next time. A few other quick updates for 2023. The basic personal amount has finally hit that magic number of $15,000 that they promised a few years ago. Of course, it is reduced on a sliding scale when income is over 165 and completely gone at 235. So you're stuck with the old basic amount of 13,521. There are a couple of new benefits. I won't spend a lot of time on these. The new Canada Dental benefit, the one-time Canada Housing benefit. A lot of our clients may not qualify, but your kids might. I know my daughter, who's in university, was very keen to get her $500 as a low-income renter. She's low income because I pay for all of it. But at the end of the day, she got her $500 from the Canada Housing benefit because she pays rent, or maybe I paid rent through her. So, that's something that some clients could consider. The new trust reporting rules, we could do 45 minutes on this, and I'm bored by this topic already. But just remember that there are new rules for 2023, and you got to report everything, including those bared trusts. And that's what everyone's kind of freaking out about, not to mention the underused housing tax. There are some exempt trusts, obviously, new trusts under 3 months, if there's under $50,000 and they're invested in publicly traded securities. And obviously all registered plan trusts are exempt from this new rule. The limits for RRSPs and TFSAs, the RSP limit is $30,780 this year. The TFSA limit is $6,500. And if you look at the cumulative limit, we're now up to $88,000, depending on the age of the client, the year they turned the age of 18, and if you add up all the dollar limits. And this is really a big opportunity. So, for clients to put in the $88,000 for themselves, maybe they have a spouse, maybe they have a partner, maybe they've got kids who are at least 18 years of age. This is a great gifting strategy of giving each kid $6,500 a year so they can put it into their own TFSA. And we'll come back to this a little bit later. Also, when we talk about the new first home savings account, is another intergenerational wealth transfer strategy. Now you say, well, TFSAs, what can actually go wrong? The TFSA was really designed to be straightforward, right? You put after-tax dollars in, you invest them in pretty much anything tax-free. You withdraw anything for any reason with no tax. And then you can fair market value recontribute the following year. So any withdrawals that you come out, including contributions, income, and growth, can go in the following calendar year. So what can go wrong? Well, here's at least 6 cases this year alone of people doing things. I won't go into a lot of detail very quickly. The most recent case was the Farid Ahmed TFSA trustee case, where you had, I wrote about this in the paper, by the way, a couple of weeks ago, but basically someone was day trading in their TFSA. So they put in $15,000. They took out $547,000 3 years later. And this is through day trading. I think there was also maybe some swap activity going on. It's a little bit unclear how he did it. Very speculative securities. And the CRA taxed him for running a business very punitively, right, inside of your TFSA. Now, this is very different, by the way, than the tax law on RSPs and RIFs. I mean, if you look at the folio, which is just clarifying what's in the Income Tax Act, if an RSP or RIF were to engage in the business of day trading, and as long as it invests in qualified investments, it's not taxable. And this is what the taxpayers said should have happened for the TFSA. And they said there can be no legislative reason why the TFSA should be any different. Unfortunately, the court said that, look, if Parliament wanted to exempt TFSAs from carrying on a business, including trading in qualified investments, it would have done so. And it didn't do so. And therefore, you're stuck. And he was hit with taxes for 3 years in TFSA. So, look, we tell all of our clients, you want to do day trading, do it in your RSP, do it in your RIF. Do not do it in your TFSA. Fundamentally, if you sort of think about it, there's no reason why it shouldn't be allowed in the TFSA as well. I mean, TFSA is just a mirror of the RSP and RIF. And we had this debate in the newspaper a couple of weeks ago where I was writing a column. It's basically saying, look, RSPs really are the same as TFSAs. They both allow you to earn tax-free investment income. One, you pay the tax now, 2, they pay tax later. But really, the net return, really, at the end of the day, when you take into account the refund, is exactly the same. So if they're going to allow qualified investment day trading and RSP, they really should allow it in the TFSA. There was even an article in the Canadian Tax Highlights, 5 or 6 years ago, saying that this is really an anomaly. But anyway, this is the law, and this taxpayer just lost the case. So I think, this is the right advice that we need to be giving. Do not day trade in your TFSA. Prescribed rate is currently 4%. It's going to 5% on April the 1st. And again, that is the rate for income splitting. So we're not seeing a lot of prescribed rate loans anymore at 4% when we did it at 1%. The capital gains inclusion rate has been all over the map. It's still at 50%. It was 0, of course, before 1972. But it's now at 50%. People are saying, well, could it go back up to 75%? Well, it could go back up. I mean, we're not sure. We wrote a piece a few years ago. We keep updating this in terms of what do you do if you think the capital gains inclusion rate is going to go up? And of course, you have those standard strategies that I'm sure most of us know about, where you can roll it into a corporation using Section 85. And of course, the Section 85 election is not due until the filing date of the return the following year. And you have some time. You bought yourself some time. The problem is that if it doesn't go up and you elect at cost, effectively, you've now got all your securities in the corporation, and they got to file corporate returns, and maybe that's not good from an integration perspective. Installments, again, installments are due, 4 times a year. March 15th is next week. So again, if someone has over $3,000, I mean, why someone would voluntarily pay installments is beyond my understanding. Like we had someone last week who said that they didn't know how much to pay in installments. I said, well, what did CRA say? And they said, oh, CRA didn't send us any notice. I said, well, you don't have to pay installments. I mean, it's that simple, right? I would go online, check my account to make sure you didn't miss it. But, theoretically, you only have to pay, if you owe tax, right, in the prior year over $3,000, not from source. So current year, prior 2 years. So again, there's 3 options, right? The no calculation. I tell all clients use the CRA option. You could use the prior option. Some people do use the current year option. You got to be careful, use the current year option, because there was a case I wrote about a few weeks ago where, someone basically used the current year option because last year was an anomaly, but then they made a mistake and they were offside because they got a big payment at the end of the year. It was actually a payment of a dividend from a company they controlled. So the judge wasn't that sympathetic because they probably could have known about that. But anyway, they were hit with installment interest, installment penalty. So, you want to make sure you pay your correct installments. The interest on that is currently 8%. And on April 1st, it goes to 9% non-deductible daily compounded interest. If you're in the top rate in Ontario, you've got to earn 20% pre-tax at a 53.5% rate of return, a tax rate, to be able to get 9% after tax. So the message for everyone on the thing is clients should always, 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 always pay no matter what, because if they're right, and hopefully they'll be right, they're going to get the money back. And I think that's, something that's really important. So think about that. What about corporate tax? So I was asked to spend 3 minutes on corporate tax. So corporate tax, we have our tax rates for this year. No change. 12.2% on small business deduction income, first 500,000, assuming no clawback. 26.5% general rate income. 18.5% ABI when you have like over 150,000 of passive income. So you've lost the small business deduction federally, but not in Ontario. And then our rates on investment income, are above as well. And again, those should be percentages. So 0.31 is really 31%. Capital gains is 15, and then 38% total. So, if you really want to think about it from an integration perspective, effectively, we have perfect integration in Ontario this year. So if I earn $100,000 in my corporation and the tax rate's 12.2 because of the small business rate on the first 500,000 with no clawback, then my after-tax amount is 87.8. I pay that out as a non-eligible dividend, pay tax at 47%. You have 45,900 after tax. And that compares very, very favorably to the same 100,000 earned personally on the very right. The top rate of 53.5 leaves 46.5. So your net cost is 0.6%. And your deferral advantage is 41%. So the bottom line in Ontario is if you don't need the money, leave it in the corporation. That's kind of a general rule, right? The good news is they've reduced both the federal and Ontario small business clawback for taxable capital. It used to be between 10 and 15. It's now up from 10 to $50 million. So more of our small business corporate clients will now be eligible for the small business rate. You still have that grind when you have passive income and all the associated corporations over $50,000. So something to watch out for. Surplus stripping, I'm not even going to touch this. This was covered really, really well just a few minutes ago. But again, this is on our radar. We do think they're going to shut down surplus stripping in some kind of way in the budget. We've been saying that for 3 years. We've been wrong. So maybe this is the year they do it. But we are worried about it. We've told every client that wants to surplus strip that they should do it, get advice, and be done with it, because we don't think it'll be around much longer. There's, GAR cases and all kinds of stuff. Anyway, I won't get into this, but I think we're going to get an update there. And they'll probably tweak the bill C-208 stuff as well to just make sure it applies to genuine intergenerational business transfers. Our last topic, because, we're pushing right up against the time frame here, is 5 minutes on housing, right? There's so much going on the taxation of housing, right? So, very briefly, we've doubled the home accessibility tax credit that went from $10,000 to $20,000 last year. We've doubled the home buyer's amount for a first-time home buyer, went from $5,000 to $10,000 last year. And then brand new for this year that started January 1st is the multi-generational home renovation credit. That's $50,000 at a 15%. This is a refundable credit. And as long as you build a self-contained dwelling unit for someone over 65 or someone with a disability as a relative to live with you, then you'll be eligible for this brand new credit. That's $50,000 for this year. Now, some other things, obviously, underused housing tax. We've discussed that already. The new 2-year ban on foreign investment in Canadian housing applies for this year and next year. There's a new anti-flipping rule, and we're also going to discuss the first home savings account. So the anti-flipping rule, right? This has been in effect since January 1st of this year. basically says if you sell residential real estate and you own it for less than 12 months, 100% income inclusion. No principal residence exemption, no capital gain, including the sale of a rental property, by the way. So you got to be very, very careful. There are certain exceptions to that. Won't apply on things like death, separation, disability, things like that. But again, we're telling clients to be very, very cautious when it comes to principal residences and residential real estate. Now, there was an article in the Canadian Tax for the Owner Manager by the Canadian Tax Foundation in January, a couple of months ago, where they're basically questioning finance's projection. They're saying, new revenue of $15 million in each of 2023 and 2027, but tax revenues actually they think will be a lot lower because already CRA assumes that, the auditors are assuming that any home owned under 2 years was for resale. They're disallowing the principal residence exemption, and the courts are generally upholding those with flips, right? So you got to be careful with that. And again, they may just not get, the revenue they expected. There are all kinds of proposals. Of the most recent Tax Journal went through a policy forum, possibly revisiting the principal residence exemption in the first place. Like, it costs $10 billion of lost government tax revenue, encourages really Canadians to put all their money in their home because it's going to be tax-free, and then maybe not use more productive assets in the economy for small business and for public companies and things like that. So this particular author suggested that maybe we, tax, we put a surtax on the value of principal residence exemptions, above a certain dollar amount. So again, this is also something that, could be coming in the future. And then finally, the last, 3 minutes that I have left, let me just talk about the most exciting new plan for most Canadians that have not owned a home is the First Home Savings Account. So again, this is expected to launch as early as April 1st. So far, no one's going to be ready, I don't think, for April 1st. There was just a recent report that RBC thinks they're going to launch some kind of plan in the spring. Most of the other banks will probably follow in July or in the fall, summer or fall. So to open up an FHSA, you've got to be 18, you've got to be a resident of Canada, you've got to be a first-time home buyer, which is defined as someone who doesn't own a home in the current year and the previous 4 calendar years. You can only do this once in your life to buy a single property, and you must close out the FHSA by the year after you take the money out at the end of 15 years or the year you turn 71, whichever comes first. So the FHSA can be used to buy a home. If it's not, it can be used to supplement your RSP or RIF, or you can simply take it all out and pay tax. So contributions, right? You can contribute cash, you can contribute securities in kind. Of course, there's disposition and stop loss rules if you do that. And you can even move money, by the way, from an existing RSP for which you got a deduction for over into the FHSA on a completely tax-deferred basis. Now, you don't get a deduction for that. It doesn't reinstate the room, but it is another possibility. So the best thing is that when you put money into the FHSA, you get a tax deduction for that. It's limited to $8,000 a year, plus any carry forward, but you have to read the fine print. The carry forward itself is limited to $8,000. So eventually you can catch up. The maximum is $40,000 during the 15-year lifetime of the plan. And if you overcontribute, there's penalties of 1% per month. So the deduction can be claimed in the current year or in a future year. Like if you give your kid $8,000 and they're 18, they may not need the deduction. So they can claim that deduction 10 years down the road, right? That's a legitimate planning opportunity. Now, anything investments, we'll see different financial institutions will launch different types of plans. But all the qualified investment rules for RSPs and TFSAs apply. Mutual funds, securities, bonds, GICs, things like that. And all the prohibited investment rules will apply. And as long as you follow the rules, there's no tax on the income and growth. So you got the tax deduction on the way in. You have complete tax sheltering while it's in the plan. And if you take it out to buy a home, you basically take it out tax-free, not just your contributions, but all the income and growth with no upper limit. So again, in the year of withdrawal, you still have to be a first-time home buyer, which means you haven't lived in a home in the current and prior 4 years. You have to have signed a written agreement to buy the home. You have to intend to occupy the home as a principal residence, not a rental or income property. And you still must be a resident of Canada. And if you meet those conditions, the entire FHSA balance can be withdrawn tax-free. And the legislation clarified that you can also participate in the home buyer's plan for the same purchase. So you could do the FHSA for $40,000 plus income and growth, another $35,000 from the home buyer's plan paid back over 15 years without any negative consequences. And then finally, if you don't buy a home, there's no risk. Every renter should use their first home savings account, right? Because if you don't buy a home within 15 years, you simply can move the entire balance of the FHSA into the RSP or RIF. You do this up until age 71 or the end of 15 years, whichever comes first. It's a tax-deferred transfer. It doesn't affect your RSP room or your FHA limit. And ultimately, that'll pay tax when you take the amount out of the RSP or RIF. If you don't move it into your RSP or RIF, obviously, if you take it out, it's going to be taxable. So I think that, FHSAs will become the plan of the future for anyone 18 years of age or older that wants to save for their first home. In fact, recent analysis shows that there's no reason why you couldn't put the money in on Tuesday and buy a home on Wednesday and take it out tax-free. So you're getting an $8,000 deduction for having the money in there for a day because there's no minimum number of days it has to stay in the plan like there is with the home buyer's plan. I think there's a 90-day test. So you got to be very careful there. So anyway, look, lots of opportunities. I know I went fast. And the reason I went fast, because I had a lot to cover. You had to do 50 slides in 25 minutes is really 30 seconds a slide, right? Or maybe 2 minutes a slide. Oh, no, get the math right. 30 seconds a slide. So, we tried to cover as much as possible. Unfortunately, there is no Q&A today, which is great for me. It's bad for you. But at the end of the day, all this information is available online. So if you go to either cibc.com or jamiegolombek.com, every article I've ever written in 26 years is on there. And it's all indexed and searchable, and all the CIBC bulletins, there's 75 of them, are also available on either of these sites. So again, Dean, thanks again for having me back to talk to fellow CPAs in Ottawa, and wish everyone all the best for tax season and many happy returns.
Jamie, let me just ask you one question so you don't get off too easy here. Out of all, I know you're a simplicity guy. You're not a fan of these boutique tax credits and some of these changes that feel more political. Out of the changes that have come this year, are there any that you really like from a policy standpoint that you feel are going to ultimately help Canadians and not compromise the tax base too much?
Well, it's hard. I mean, I love the FHSA. I think it's too good. And we wrote to them. I wrote an article about this. Actually, I got an article published last year, the Canadian Tax Journal, back in the fall, suggesting that this program's too good. I mean, really, that you should use, if you don't buy a home, you should be able to have to use RSP room to put it in. But no, they didn't listen to that. They went for, pure simplicity. So look, I mean, they made the plan simpler. The problem is, do we really need another plan in the first place? So look, I think this is a game changer. I can't see why anyone who has any remote chance they're going to buy a home within 15 years would not use the FHSA for, down payment savings. So, would I have done it this way? No way. But I would tell every single client to do it and everyone to set it up for their kids. There really is no downside. Like, I guess the only downside is the kid's 18 and they don't buy a home in 15 years because they want to buy it in 17 years.
Right.
Oh, well, then they missed out, right? But did they really miss out? Money's in the RSP. So, maybe that's the downside, but I would encourage everyone to do the FHSA. There haven't been a lot of other, changes at all. I mean, the home renovation thing is cute, but how many people really renovate a basement suite for a relative or someone else to live in there? Not many, from what we've been told.
Right. Okay. Excellent. Jamie, thank you so much. Great to have you back. We really appreciate it.
My pleasure. Thanks, Dean.
Excellent. And as I mentioned, everyone will get a recording of this so you can go over and maybe put it in slow motion and try and consume everything that Jamie just told us. I want to do our thank yous first. Our speakers, they were fantastic. We had 4 of them: Helen G, Elvin Green, Manu Kakar, and Jamie Golombek. Thank you for being here. You were wonderful. Our producer is Khaled Jabbar at Future Vision Productions. He's wonderful. He makes this all look slick, and I'm grateful to him. The Ottawa Business Journal also helps us promote and produce this event, so we're grateful to them as well. Jennifer Daw, Ayo Ogundipe, Joe from Video Tax News, they all advised me on which topics and issues were important to you right now and which speakers to get. So thank you to them. Speaking of Joe Devaney from Video Tax News, I understand that there were some questions on our YouTube chat, and I was here just consuming the speakers and enjoying them. And Joe was on the YouTube chat answering all the questions. So thank you, Joe, for swooping in there. I appreciate that. Remember the survey that I mentioned, blatchfordtaxlaw.com, and it's right at the top. And it would be great if you click that and took the survey. It'll take you less than 5 minutes. Would really appreciate it. Finally, thank you to you, the audience. this is maybe you've been coming to these for a long time, but this was record-setting numbers, and we're very happy to have you here. People from all across the country, some non-CPAs emailing me trying to figure out how to register. You're all welcome, and we're glad that you're all here. Thanks so much. We'll see you again next year, and definitely before that.